Revenue finally showed up at AST SpaceMobile this quarter, but so did a wider operational loss, a lost satellite, and another $750 million in fresh debt. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. AST SpaceMobile gets graded and traded. So on the headline, revenue came in about 8% below the estimate. But I want to give context here, because the year-over-year number is the real story. Revenue jumped to $31.5 million versus just $1.2 million a year ago. That's the first meaningful revenue quarter this company has ever posted. And on the EPS line, they reported a loss of 77 cents per share, which was about 21% worse than the estimate. But here's the catch. Most of that miss came from a $125.9 million non-cash loss on the BB-7 satellite that was involuntarily lost. Strip that out, and the clean loss per share was closer to 35 cents, still wider than the 41-cent loss from a year ago on an operational basis. So, on the beat itself. And remember, we're grading against the headline surprise here. This earns an F. They missed on both the top line and the bottom line, and even backing out the satellite charge, the operational burn is still widening year over year. And on consistency, this earns an F. This company doesn't have a track record of clean beats, and results are driven by launch cadence and constellation milestones, rather than repeatable financial execution. Let's talk about the positives from the report. The top line finally showed up in a real way. $31.5 million in total revenue versus just $1.2 million a year ago. Products revenue was $24.4 million. Services was $7.1 million. This is the earliest sign that AST SpaceMobile is transitioning from pure research and development into actual commercial monetization. Liquidity is still in a strong spot. $2.29 billion in cash plus another $434 million in restricted cash gives them about $2.72 billion in total liquidity to fund the constellation build-out. Total assets climbed to $5.85 billion from just over $5 billion at year-end. Capital markets access is clearly still open. Financing activities generated $1.07 billion in the first half. That's about $1.06 billion in debt proceeds and another $85.7 million in equity. They also refinanced a chunk of convertible notes, which is a meaningful liability management move. The infrastructure build-out is accelerating in real time. Property and equipment jumped to $2.07 billion from about $1.4 billion at year-end. That's roughly a $670 million increase in just 6 months, with $859 million in first-half capex. The constellation is being paid for aggressively. And on the BB-7 satellite loss, they did recover $21.6 million in insurance proceeds, which softened the blow of the $125.9 million non-cash charge. So on profitability, this earns a D, because operating expenses quadrupled year over year, and even backing out the satellite charge, the underlying burn is still widening. Now, let's talk about the negatives from the report. The reported net loss attributable to common stockholders more than doubled to $230.9 million, or 77 cents per share, versus $99.4 million and a 41-cent loss a year ago. Even backing out the one-time satellite charge, the clean operational loss was around $105 million, still wider than the year-ago period. Operating expenses ballooned to $329 million from just $74 million a year ago. Engineering services costs alone tripled to $87.3 million, and G&A more than doubled to $63.9 million. Cost structure is scaling way ahead of revenue. The leverage story is intensifying. Long-term debt jumped to $2.96 billion from $2.21 billion at year-end. That's about $750 million added in 6 months. Interest expense in the quarter alone was $26.1 million versus $5.7 million a year ago. And right now, interest income of $27.7 million is masking the true interest burden. Cash burn is accelerating too. Operating cash used was $145 million in the first half versus $72 million a year ago, and investing outflows were $980 million on top of that. That means the business burned over $1.1 billion of cash before financing activities. The constellation is being funded entirely by capital markets, not operations. And dilution is a real headwind. Class A shares outstanding rose to 299.7 million from 285.4 million at year end, and stock-based compensation of 118.8 million in the first half is a material dilution vector on top of continued equity raises. On guidance, this lands at a C. The press release didn't include forward revenue or EBITDA numbers, so this is reduced visibility, not evasion. I expect them to address forward guidance on the earnings call. And on red flags, I'm at a D. The widening cash burn, the $750 million jump in long-term debt in just 6 months, and the continued dilution are all pointing in the wrong direction, even though liquidity today still looks comfortable. Putting it all together, this print is a genuine mixed bag. Revenue finally emerged in a meaningful way, and capital markets access is clearly still there. But operating expenses quadrupled, long-term debt jumped another $750 million in 6 months, and the clean operational loss still widened year over year. Reasonable bulls and bears can look at this same report and walk away with opposite conclusions. I'm giving this print a D-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. Looking at this print, I'm not seeing a clean fundamentals entry here. Revenue is finally showing up, but the burn is getting worse, not better. So if I'm getting in, I'm treating this like a speculative bet on the constellation build-out, not a value play. That means small size for me. My move is to sell cash-secured puts way below where the stock trades right now, taking advantage of the fat premium after earnings. If I get assigned, I get a small conviction piece. For me, this is a small speculative entry through puts. When I'm picking my put strikes here, I'm staying way out of the money. This company burned over $1.1 billion in the first half, and they keep issuing equity to fund it. Any strike close to the current price puts me right in the path of a dilutive capital raise or a launch delay headline. I don't want to eat that assignment. The tricky part is the gap. A strike I'd survive on a bad headline sits way below spot, and a strike where I'd actually welcome the shares sits much closer. That's the wheel dilemma on this name for me. My strikes stay far out of the money. As a shareholder, I got what I needed this quarter. Revenue went from $1.2 million a year ago to $31.5 million, and they still have access to capital. The core thesis is intact for me. But that $125.9 million loss on the BB-7 satellite and the growing burn tell me this isn't the spot to add aggressively. My plan is to trim some shares into any launch catalyst rally and hold a core position through the multi-year constellation ramp. I'm not going all in, I'm not walking away. I trim on strength and hold my core. With implied volatility jacked up after the print, my covered calls are paying nicely. The premium harvest here is legitimately good for me. But I'm keeping my strikes well above the current price. A carrier partnership headline or a launch announcement could rip this stock, and I don't want to cap myself too tight. If we get a sharp rally, I'm rolling my calls up and out rather than letting my shares get called away cheap. On a name like this, the next big announcement could reprice the whole story. I roll up and out on rallies. My leaps got mixed signals here. The revenue finally showing up supports the multi-year story I bought into, so the thesis is still alive. But the $750 million jump in long-term debt over 6 months, plus more share dilution, both eat into what each of my shares is eventually worth if this works. So my 12 to 24 month thesis is intact but noisier. On any launch-driven pop, I'd rather roll my leaps up and out than close them, because taking profits now gives up the asymmetric upside that got me into these in the first place. I roll up and out and keep the upside. If I'm sitting underwater on this one, the print doesn't cleanly rescue or kill my thesis. Revenue is finally arriving, which is real, but it's not a decisive win. The problem is the burn and the dilution are both getting worse, not better. Every quarter, my share of the eventual pie gets a little smaller. For me, adding here only makes sense if I have deep conviction on the multi-year Constellation story and can stomach more dilution. If I was betting on a near-term commercial ramp, this print says that's still over a year away, and cutting my exposure is a defensible move. I only add on high conviction. Bottom line, this print earns a D- from me. Revenue finally showed up, but the burn, the debt, and the dilution are all accelerating right alongside it. This is still a binary catalyst name driven by launch cadence and carrier partnerships, not a clean financial story. Thanks for watching, and I'll see you on the next one.